It's important for you to realize that it's ultimately you that will undo you. So the way you avoid failing in trading is not looking at temporary setbacks as definitive failure. No, that was a tax on your participation in the marketplace. You need to figure out who you are as a trader in that environment because that is the battlefield. But failure is a choice. You're by yourself here. I didn't fail you. The market didn't fail you. Somebody else that's taught you how to trade didn't fail you. You failed you. You did. You stopped. You gave up. You rang the bell. You went home. It's over for you. These are things that mentors don't talk to you about because they don't have any answer for it. I'm telling you how to navigate the hard right edge. And most of it is in between your ears. How do you manage yourself? That needs to be right in front of you every single day. One step at a time, one day at a time, and let that day's learning be enough. And it will compound. If you can determine where the market is most likely, not all the time, most likely where it's going to reach for, where price is trying to travel to. It's trying to go up or it's trying to go down. And here's the thing that you need to understand. There may be times where that bias is not obvious. What do you do in those circumstances? Nothing. You wait. You simply wait. What are you waiting for? For the period of time when it is obvious to you what it's trying to reach for. And as soon as you identify it and you know what it's likely to draw for, higher or lower, then you determine, are we in a specific time of day that is conducive for a sustained price run? Between 9:30 and 11 o'clock, there's a strong tendency for the market to want to do what? Move. If you do that, you're on your first steps to avoiding failure. Because everybody that doesn't know where the market's likely to go, they're failing. The plot escapes them. They have no idea what they're doing. Zero. But if you understand that skill set and you get good at where the market's likely to go to, the next thing you need to understand is risk management. But ICT, I need an entry. No, you don't. Because you literally can buy or sell any fucking where if you're right on the draw and your risk management is appropriate. As soon as you identify the draw, determine how far it can go against you before that idea would be null and void for that session. And put the stop loss at where you think it would fail in that idea. And you put a limit order at the draw. And work with that. Accept the facts that when you get it wrong, okay, what didn't you see in the chart? Go into your charts and really break it down. What was there that you didn't notice? You have to have that mindset. And you do this every day. And you condition yourself every day. That's the first mystery that you have to solve in trading. Anybody that tells you that your job is not to try to predict price is a fucking moron. That's fucking gambling. It's fucking gambling. I am not a gambler. I'm looking in there. I said, okay, there's a real reason for the market to go up there. Why? There's a huge pool of liquidity in the form of buy stops. There's a huge pool of liquidity in the form of sell stops. It hasn't been there in recent times. And we have seen the other side of that liquidity matrix tapped multiple times. And it's not showing a willingness to want to go in that direction anymore. So what's it going to do? It's going to revert back to the opposing side of liquidity. The mechanism for these price engines are going to be on the basis of two fucking things. Inefficiency above or below the marketplace. That's a fair value gap or real gap. What's a real gap? Opening range gap. A new week opening gap where there's no transactions made between two price points, or above old highs for buy side or below old lows for sell side. That's it, folks. Every session, the opening range is 9:30 to 10 o'clock in the morning, New York local time. So it's a 30-minute window. You wait. Which side did they run for at the 9:30 opening? They took the buy side. Okay, wonderful. Where's counterparty liquidity? That draw is like a magnet. So we can anticipate. We can predict. We're anticipating. We are predicting that the market is likely, most probable, to go towards its opposing liquidity. So our belief is this: at 9:30, there's always some kind of measure of manipulation. That Judas swing, that fake price run that gets everybody hopped up thinking it's going to go because it did this first. Okay. But that first initial run higher to the buy side, that makes it likely that we're going to go lower. If we put a fib on that high down to that low using that implied dealing range. Now, implied dealing range means that we are anticipating a price run in a direction and anticipate everything at the 50% level or higher is deemed high probability for a short. That's what the algorithm's focus is. It's presenting opportunities for that very condition.